Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another phenomenal episode for you today. I've got a guest that I've been excited about having on the show for quite some time now. This is someone that has a tremendous amount of experience. He's acquired in the last 10 years over $2 billion worth of multifamily real estate in a few different Texas markets. He has a background in commercial banking in the multifamily space, 15-year career there, and then transitioned to multifamily investing about 10 years ago, and has acquired, like I said, over $2 billion. He currently has a portfolio of roughly 6,000 units and about $1.5 billion. Just a wealth of knowledge. He's also the co-host of a popular multifamily investing podcast titled the Old Capital Podcast. And so I'm really excited to have Michael Becker on the show with us today. We dive into a handful of things, from his outlook on the market to why he's chosen to avoid bringing property management in-house and working through third-party property management. We talk about how he would start his business today if he were starting over, what strategies he would deploy. We talk about his transition from B and C class assets to A class assets and how he may consider going back to B and C class assets as the market starts to shift. So a ton of insight, a ton of knowledge that he has to share with you, and I'm really excited to have him. So without further ado, Mr. Michael Becker. Mr. Michael Becker, honored to have you on our show with us today. Thanks for spending some time with us.
Hey, thanks for having me on, David.
So I've already given the listeners a little bit of insight to your background and your business, but maybe if you can, let's start off by just talking about where your business is at today. SPI Advisory. What does your business look like? What do you have under management? How is your business structured? Maybe just give us some high-level overview of what things look like.
Yeah, so I'm based in Dallas, Texas. Company I runs SPI Advisory. I have my partner Sean is based in Austin. So we have two offices, one in Dallas, which I had, one in Austin. There's 12 of us in our company right now. Partner and I, 10 employees. We've done 13 plus thousand units over the last 9-10 years in Texas. And today, as we speak, we're a little bit over 6,000 units or so. Portfolio, probably about $1.5 billion, give or take, in valuation. Started out doing a lot of the, generally workforce housing. So kind of in Texas, things like 1960s or 1970s kind of for vintage, then transitioned a bunch of 80s. And then for the last five or better years now, really what we kind of focus on is kind of A minus. So, generally speaking, 20 years or younger. We started only in Dallas. We expanded to Austin and San Antonio as well. So it's been, it's been a heck of a good run, no doubt about it.
Well, so I usually sort of leave this question for later on in an interview, but I'm going to ask you right out the gate. Like, okay, what keeps you motivated at this point? Like, look, you've had a great run. You've been in the space. Your previous professional experience lend itself very well to being able to dive into the investing side of the business and really go at this hard for the last 10 years. So you've got a decade of buying, close to over $2 billion worth of multifamily in a very localized sort of geographic area. I mean, you could probably sit back at this point in time and sort of enjoy what you've built over the last decade. What keeps you motivated at this point to move forward?
Yeah, some days I ask myself that question too, because some days are, not every day is easy, right? I mean, there's always problems, right? But yeah, I'm just turning 44, so I'm too young to sit at home. My kids are in 5th grade and 7th grade, so got to be stuck in Dallas until they get out of high school. So I got another 7-8 years left before my son gets out of high school, and that's one reason. And then two, really like the really kind of still like the art of the deal. I'm kind of a deal junkie. Always been a deal junkie from my banker days. I mean, being a banker, you're pretty transactional, doing kind of beginning, starting, and now we're still pretty transactional. Obviously, we're buying and selling, but you have a little longer. Got to own and operate, and have kind of the in between phase a little bit more than I did when I was a banker. But So we're like doing the deals. I don't have that many hobbies, so I'd probably be bored to death if I didn't do something. So we're still in the process of trying to build the infrastructure of the company out such where when I'm ready to go away, I can go away. I'm still pretty involved in the day to day business, even though it's much less than it has been. Historically, we're keep layering in more people and systems and infrastructure. So hopefully by next 7 or 8 years, I can kind of step away and just do the fun things and not do and don't do the things I don't like. So still have to do a lot of things I don't like, but we're getting more and more towards that goal. So hopefully by then I just kind of come in when I want to come in and do the things I want to do.
Well, and I think it seems you've been fairly intentional about building a business that does allow you to be a little bit more flexible than maybe some others. So I've noticed as I've observed other investors who have built similar business to yours and have gotten to a place where they have some serious scale. They've acquired close to $1 billion or more in multifamily. They've brought management in-house. And then they end up having hundreds of employees that they have to manage on that side of the business. You've been able to run, 10 employees at this point, probably some, principals in the company outside. Pretty lean and mean for what you've acquired over the last 10 years. Maybe give us some insights into your thoughts about bringing management in-house versus what you've done, which I believe I'm accurate on this, that you use third-party management. Is that correct?
Yeah, that's right. So we've stayed away from that. Property management is kind of the worst end of this whole business. That's where all the problems, or the majority of the problems, are, at least. So we use a regional company here that's based in Dallas, and they manage all our stuff, and we're the largest client. So probably no one cares about your money as much as you do. So having it in-house, all things being equal, is probably better. Being fully vertically integrated is probably better, all things being equal, but really don't have the interest. And like you mentioned, I'd be 150 to 200 employees in our organization if we were fully vertically integrated. So I think I kind of have the next best thing and get to kind of avoid a lot of the headaches and really focus on the things that really drive the most revenue, which is sourcing deals and sourcing capital. So if you're a apartment syndicator, sponsor, or whatever you want to call it, those are really kind of the two highest and best use of my time. It's finding deals and finding money. So having the outsource works well for us. There's no right or wrong in this business. People do things a little bit different, whatever kind of fits their personality. But grinding out day to day property management certainly doesn't fit my personality nor my partner. So we've chosen to kind of works well as it is. So that's why rock the boat. It's kind of been the thought process around it.
Yeah, it makes a lot of sense. So let's talk a little bit about what's happening in the market right now and how you guys are navigating it. A tremendous amount of experience. You've been at it for a decade. You've bought a lot of real estate, and you've seen at least, you went through the pandemic. You navigated that with a significant portfolio. Now we have sort of a debt situation on our hands. Maybe give us your just high level thoughts about what's happening in the market today and what you and your partners are planning on moving forward into the latter half of this year, the third and fourth quarter of this year. So just for context, we're recording this just the end of August 2022.
Yeah, so I was a banker during the great financial crisis, right? So 2008, 2009. I was kind of the grim reaper. So I started my banking career kind of early mid 2000s, and that the first part of my banking career, you couldn't make a bad loan. Everything's kind of went up, and then one day that all changed quickly, and and then that was a pretty deep, severe recession. The banks kind of froze. I was working at a bank. So you go from being, pretty liked, respected profession to kind of being evil overnight. Somehow it's kind of, I don't know what we did, but what I did at least. And then, had about 18 months of just doing problem loan workout, trying to collect a bunch of money. My bank would have failed for sure, but we got bought by Wells Fargo. It was with like a regional bank. We got bought by Wells Fargo in '08. and then kind of coming out of that, started buying investment real estate in 2011 and started doing apartments in 2013.
Mm,
And, so the entire time up into, 2020, it was just, nothing but the wind at my back. It's been, great environment. So then, 2020 was a little challenging, but it really at the a lot of fear and anxiety going into, March collections of 2020 when everything's kind of shut down. But reality turned out it really wasn't that impactful with all the
mm-hmm.
money they printed. And then that's all the way up until about February of 2022 this year. And everything was kind of going gangbusters, and you start getting into March and April, and then and things started kind of really starting in April with the Fed hikes. And then you started what was a very robust and diverse roster of lenders that was available as we started 2022. Quickly, a lot of those guys kind of put pencils down, and the amount of liquidity in the debt market, and then the amount of liquidity that was chasing it from an equity standpoint certainly dried up starting in April. And June, July were pretty tough months. There's not a lot of transactional volume. And then now here we are kind of coming out of the summer. We're starting to see that kind of open up a little bit. July, August was much more liquidity, and kind of into July going into August. We found that the Fannie and Freddie model is working. There's some combination of them getting a little bit more aggressive, trying to provide a backstop and liquidity, which is unique to the multifamily industry. You don't have that in
Mm-hmm.
retail or office or industrial. It's only for multifamily. And then some of the pricing, kind of coming in a little bit, and then as well as the operations from occupancy and rental rates are still very strong. So some combination of all that is seeing, and the agencies kind of come back to play. It feels like we're kind of in the space I play, which is more your class A, kind of the A minus, starting to see kind of some floors get set where I think price adjustments have happened from the peak, probably 10 to 15%, and starting to see some floors in Dallas and Austin. I think we're seeing some signs of that in San Antonio as well. And then, I think workforce housing, I think, we've been kind of lumping together B and C class deals. And I think we're starting to see, tiers of the risk start coming back into the pricing of these things.
Mm-hmm.
Where, when I started in Dallas in 2013, you could buy a brand new class A deal for like a 5 cap. A B deal was like 6 to 6.5, and a C deal was like 8 to 8.5. And fast forward to the start of this year, everything was essentially a 4 cap or lower. There was very little of spread between the top of the grade and the bottom of the grade. You're probably talking 50 to 75 basis points in cap rate spread, which historically has been more like 300 or 350 basis points. So as we're seeing choppiness in the market, I think we're seeing the cap rates expand, generally speaking, but they're expanding at a much slower rate on a class A and a much larger rate on a class C. So I think there's going to be some tiers priced back in where C class 60s and 70s deals in the Sun Belt are going to price at a higher cap rate than the 80s deals, which are then priced at a higher cap rate than the kind of newer stuff. So it's still kind of playing out. It's not fully settled and established, but that's kind of what we're seeing. So I think there's still probably a little bit of room to go on the lower end of the grade, and I think we're catching bids on the upper end of the property grade. That's kind of what I'm seeing in Texas, and I think that's probably generally the Sun Belt as well.
And early on, you guys focused mainly on B and C class, value add plays. You described sort of this blending of different asset classes, and the cap rate difference, being maybe a lot tighter than it was previous to that. And so your strategy shifted from B and C class to move to A class because you saw the risk adjusted returns being very similar, or actually less if you moved into the A class space. You're able to achieve similar return profile without all the risk and all the headaches of doing the deep value add stuff. But you did just allude to the fact that you start to see the classes separating again from a cap rate perspective. Would that warrant you going back into maybe B class assets in the future? Do you see that as an opportunity?
I think that's a possibility, right? I don't think we're quite to that point yet, but I mean, at some point, Yeah, you described it right. I mean, on a risk adjusted basis, the marginal amount of return you can pick up by doing the workforce housing the last few years just didn't make any sense to us. Now, arguably, or admittedly, I was a little early in that call. I mean, we bought 8 caps and raised revenue 25-30%, sold at a 6 cap. I didn't know it was going to go to like a 4, right? Otherwise, we might have hung on a little bit longer. That that trade got a little bit tighter than I thought it would, but I think we're being proven out to be a little wise if not early, but still wise with that decision in real time. And certainly left some dollars on the table along the way. But yeah, I think as they expand out, I mean, I think that makes some sense, because what we do, there's a lot less things to mess up buying something that's, newer. You don't have to do all the value add. And then, the value add is even tougher nowadays with the supply chain issues and trying to get appliances and flooring, and those costs are going up dramatically. And I don't have quite the same capital risk. In the newer deal, you do these older deals. And I think what's also happening in real time, you're starting to see some, more elevated and maybe more on a permanent basis, some collection issues. And that's much more pronounced on the lower end of the property grade and your, workforce housing C-class stuff, because those tenants, generally speaking, have lower incomes in that demographic, and they're getting squeezed more by everyday inflation on everything in their lives. So they're having some more elevated collection items. I think that is probably not as widely discussed as it probably will be in the near future. And so you're going to have some elevated collection loss that hasn't been there, and still got some lingering eviction moratorium. It's not, the moratoriums are largely gone in the Sun Belt, but it's still, what used to be 30 days to get someone out, even in Texas, still takes you 2 to 3 months. So even with it, the court system's still a little bit not back to pre-pandemic normals. So, you're going to get more and more bad debt come into your financial statements. And I think all of us have basically been underwriting that. So the moment in time, we're going to go back to, on Class A stuff, 0.5% bad debt, or the workforce housing, maybe 1% bad debt. And it probably needs to be, double that, if not a little bit more, for the foreseeable future. And if we hit a recession, obviously that'll be, even more elevated. So, there's just that level of risk in there. But I mean, at some point, if the cap rates are 250 or 300 basis point spread, and then you can go find a deal, then that just might be worth the squeeze, taking on an older project, doing the value add, and getting paid for the risk and the effort that you got to put into to go do that deal.
And let's talk a little bit about just sort of your geographic focus. You've, if I understand correctly, started out in Dallas and really focused on Dallas, and then you have expanded slightly outside of Dallas. Have you ever been tempted to go outside of Texas and do a deal in an opportunistic market?
Yeah, so we like you mentioned, we started in Dallas Fort Worth, did that for the first 5-6 years of the career, then went to Austin, and then last year went to San Antonio. So kind of been natural markets to expand into, and I've purposely stayed out of Houston. I just don't get Houston as a big market is growing. There's it's more diverse than it used to be, but the next guy can make money in Houston, and I'll go somewhere else. But yeah, at the end of last year, beginning of this year, we were talking about trying to find another market. We did a bunch of research, and we kind of narrowed it down to the Carolinas, really being, Charlotte or Raleigh, Atlanta, and Nashville were the 3 markets that kind of had similar characteristics of the markets that we played in. Took a bunch of meetings in Atlanta with Atlanta brokers and some Nashville brokers when we were at the NMHC conference in January, the National Multi-Housing Conference, which is a big apartment owners conference at the beginning of the year. So, 10-12,000 people go to this thing, all the major broker shops for all over the country. Most of the major ownership groups are there as well. So we go to it every year, took a bunch of meetings, and then we're going to start trying to fly out there. And then everything started getting wonky in, March. And so we decided to kind of, let's just kind of keep close to home. Otherwise, I think we probably would be, on an airplane going to these markets, trying to find some opportunities as we speak. But I didn't want to make a mistake, and there's enough opportunity at home, and kind of pulling back. So I think one of those markets is probably where we'll focus on to expand, because I don't want to expand into Houston, and at some point we'll need to, if we want to continue to grow, it makes some sense to pick a fourth market that isn't in Texas.
Yeah, makes sense. So, as it relates to, obviously there's some obvious challenges on the debt side of the business. On the capital side, I'm curious, how have you generally structured your deals? Are these syndication deals with, private investors? Are you dealing with family offices, maybe some preferred equity, 1031 exchange client? How does your equity side work for you guys?
Yeah, so we've never taken institutional money, so we've kind of made an intention not to. A lot of my competitors do joint venture with a private equity firm where they'll bring 10%, and the single source check will bring 90 or 95% of the money,
Hmm.
and that's just not been that attractive to us. Historically, we've done syndications for the bulk of what we've done. So, $100,000 minimum and just go out and raise the money. And then we have carved a little niche out where we'll find some 1031 work. So generally we'll form a joint venture with an individual. A typical story is they're from out of state, usually California, sold a
Mm.
property, want to come to Texas, want to buy an apartment, don't know anybody. And so they kind of find us, and then we'll do a tenant in common structure or tick structure where, that they bring some money, we bring some money, and just do a deal that way. So right now we've been able to increase the amount of the capital raises, and we actually just got in the contract on a deal in the suburban Austin, going to raise about the $84 million deal. We're going to raise 32 million bucks in equity as we speak. So hopefully 200 plus of my closest friends in the database will get in, and we do like 560 raises now, meaning
Mm.
we can advertise and generally solicit and do that. We'll have what do we have? 3,000 people in the database or something like that. And 1,000 people over the years have given us money. We're trying to be opportunistic. So what I've seen is this deal is a good example of kind of what's going on in the market. It went out in the market in April at like 96 million, got awarded
Mm.
in May at 90 million. And that buyer dropped it because they couldn't get financing in July. And then we picked it up in July. It's gotten a contract in August, and we're at 84 million. So it's a pretty healthy discount, 12 plus
Yeah.
percent off of the original guidance and 7% off of kind of where it was awarded. So we feel like it's the market's kind of bottomed and kind of coming back up. So I think we kind of maybe, time maybe a little too early to call the actual bottom. I guess we'll see if we keep going down or not, but it feels like it was kind of stabilized, and it feels like a good entry point and one of the hottest markets in the entire country in Austin, Texas. And so time will tell how smart we are. We think we're smart right now, and time can either make you look smart or humble you along the way. But it feels like a pretty good thing. And to your point on the debt, what got us really interested in it is a brand new construction, buying it from the developer, and we're getting Fannie Mae mortgage on it. It's going to be in their near stable program, and so they underwrite kind of as stabilized income and underwritten expenses, and then they issue a sizing rate at application. So basically, what effectively happens is we have a bulletproof loan amount,
Mm.
which has been what a lot of the problems have been here recently. Is you put a loan application in, and then your lender retrades you to 5%, 10% of the loan proceeds. So you're having to come up with multiple millions right before closing because you thought you're getting a $40 million mortgage, and it goes to 36 million overnight or something because your lender cuts your loan proceeds back for whatever reason. Where here we have pretty well solidified loan proceeds
Mm.
at 65 LTV, and we're like just a little bit over a 2% interest rate spread, where a lot of the debt funds are like north of 400, so north of 4%. So feels like the deal's kind of coming together, and it feels like it's kind of like I said, it feels like we're kind of water's finding its level in real time, and it feels like we're kind of building a base. And so I'm a heck of a lot more bullish than I was back if you asked me in May. Here we are kind of coming out of the summer than going into the summer. So I'm starting to see a lot of green shoots, at least
Mm.
in the Sunbelt markets, at least on the nicer stuff. I'm not saying that's going to be, if you had some 60s deal and you're over levered with a debt fund, or you invested in a deal where they had a debt fund that went to 75% and then maybe put some prep equity up to 90%, which I know I saw a lot of those deals kind of floating around. And you had to go raise rents a bunch and do a big value add. And you had a 2-year bridge loan or 3-year bridge loan. I think some of those guys might have some problems coming up. And that might be the entry point if we go back into the workforce housing, is when a couple of those guys shake out. But
Mm.
I thought they were going to have problems years ago. I thought they were going to have problems with COVID. And market just keeps rents keep growing and the market keeps going up. So maybe it'll just grow its way out of it. I don't know.
Yeah. I want to touch base on one topic. For the newer syndicators, newer operators out there that, have, maybe they've been with another firm for a while, maybe they're coming out of school, they've got their, excited eyes wide open and they're ready to trudge into this market, and all of a sudden the debt market sort of falls out of whack. Um, what advice would you have for them? Well, let me ask it this way. If you were to start over today in building SPI, how would you go about it? Would you go about it the same way you did, focused on, workforce housing, BC class value add deals? Would it be different? What would that look like for you if you were to start back over today in our current environment?
Yeah, I mean, the only thing that's certain is change, right? So everything's always changing, right? So just kind of being on top of current market conditions, because what makes sense right at this moment in time didn't make sense a few years ago. It just always is changing. So, I mean, I think the best part of the market is still the top end of the market. Now, with that said, when you're first starting out, you do what you can afford, and we certainly couldn't afford to do an $84 million deal when we first started. I mean, the first syndication we did was like 3.8, bought a 120 unit deal for $3.85 million or 30,000 a door. So, and that same deal just traded, I think, for like $19 million here recently. So, I mean, that tells you how much the market's grown. And anyway, so I think really if you're starting out, I mean, I think getting educated, both in how do you do this, one, and then two, getting educated and following kind of what is going on in the marketplace and kind of tracking trends. I mean, me having a job as a banker and paying
Mm.
attention and kind of seeing the world without having to take risk was a really good education. I think those were, tracking the market, staying on top of it. Nothing's going to really substitute from a lot of experience and looking at a lot of deals. I mean, to really gain a sense of kind of what the market is really got to look at a lot of deals.
Mm.
And, so that's really kind of what you need to really spend some time on, is underwrite deal after deal after deal and track them on whether kind of we're asking and where they're selling. And then, kind of these, you'll start seeing patterns, and, usually you'll see something that seems cheap compared to everything else. That's essentially what we do, is we just look at everything, and eventually something looks cheap compared to everything else. And that's what we try to focus on, is that opportunity. So yeah, get educated, track the market trends, get network, try to find people that can help you do a self-assessment of kind of what you have, what resources you have and where you're deficient, and then try to, network and find solutions to cure your deficiencies. So whether you have a lot of money, but you don't have experience or relationships with brokers, or if you're the young person trying to build the relationships with the brokers, but you don't have the capital to put the deal together or qualify for the mortgage, those are the things you got to kind of, it's like a puzzle. You got to get the little pieces together and the picture comes clear and you can do the deal. So, being very self aware of what you have and what you're deficient in is a good place to start. But in today's market, if I was starting out, I might just track it for a few months and kind of see where it's at. I mean, there's a wide spectrum of outcomes that could be, I think this $84 million deal we're doing is going to be great and we're going to make a ton of money, but I could be wrong. This thing could go down again. And then do I have the proper leverage at 65%? Do we have wherewithal to put some cash behind this thing? Because, when we first started, we didn't have any money. Now we've been
Mhm.
fortunate to go full cycle. So if there's got to be a check written and you invest in a deal, can you sponsor write that check, or does he got to go back to his database and his investors to kind of solve those problems? And what type of loan do you have? And there's a lot of variables within the deals as well as the sponsorship groups out there. So I don't think this is time for amateur hour quite yet. I mean, maybe beginning of next year might be a little better entry point when there's a little bit more clarity than diving in if you've never done this before.
Yeah, great insight. Thanks for that. Well, I want to start winding down here. I've got a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
We've been kind of scaling up. So two things come to mind. One from just trying to get the confidence. We're doing this deal. This is the first big raise we've done since it's been choppy. We bought a deal 6 weeks ago. That was an up leg of a 1031 that we did. So we'll see how well it's received. I think it will be well received with the discount we have. But what if this deal goes well? We're gonna close this deal hook or by crook, and we're gonna figure it out. So hopefully it goes easy. But if it goes hard, it goes hard, and we got to do what we got to do to get the deal done. But if it goes easy, it will give us confidence to continue to, try to get another one or two on the scoreboard this year. And then the other thing is we were kind of in the process of switching over our investor database. We kind of had one of the kind of off the shelf products, which worked well. It's just not everything we wanted, and we stepped up and it's going to spend 4 to 5 times the annual cost on this other one that's a lot more customizable, but it's been a grind to get the deal done, and it's taken my team a lot of time, and we're way behind schedule on it and still not done. So that's been a big hindrance just from an operational standpoint, trying to get through that project, and hopefully is great at the end of the day. Otherwise, we just wasted 6 figures on this thing and a bunch of time and payroll and energy and effort. And that's kind of, as a small business owner, which is essentially what we are, sometimes you have these great plans and things go great, and sometimes they don't, and you just got to kind of reassess and roll with the punches and deal with it, whether it's a transaction that we've done or software or an employee that you hired along the years. You just always got to kind of reevaluate and not get stuck on some sunk costs. Sometimes you got to cut bait and move on with whatever project that you have internally sometimes.
What's something that's going really well in your business that you guys are just knocking out of the park right now that we could all learn from?
I think we've done a pretty good job in general, just with our investor relations and communications, and through COVID was a big test, and I know I had nothing to do, just sitting at home like most everyone else did. So I went to extreme communication, and I was communicating weekly, if not more than once a week, just kind of because when I was sitting at home, I know I was wondering, well, what did we collect today versus what did we collect yesterday? And that was, I'm sure, what every one of the investors who've given us at least $100,000 was probably thinking, I was like, I'm going to get my money back. So communicating, we're back to normal communication. So we communicate about once a month in regular intervals. So that's one thing we do well, and that's one thing I get complimented on from people that do invest with us, is being transparent and regular within the communications. So if you're starting out, that would be something that I would prioritize, because that's the way to get referrals and generally keep problems from popping up. Because if you don't communicate, people are going to think the worst.
Yeah, absolutely. All right. Well, Michael, this has been a pleasure to have you on the show. Always appreciate your insight. I'm a listener of the Old Capital podcast. Love your insight on that show with Paul. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, I'll give you 2 resources. You just mentioned I co-host the Old Capital Real Estate Investing podcast. So you can find that on iTunes or anywhere you probably hear my voice right now, or the website's oldcapitalpodcast.com, or the company I run is SPI Advisory. That's SPI like spy advisory.com. You go to our website, there's a form you can fill out. Bunch of information. We updated our website, almost a year ago now. So used to suck, and now it's actually pretty decent. We got our portfolio, a bunch of data on us. I write a quarterly newsletter. The next one's coming out just right after Labor Day. So if you guys want to sign up for the newsletter, that's usually, we try to put a lot of energy and effort into that. So certainly encouraging you want to sign up for that and get on a distribution list for the newsletter.
Cool. So we'll have links to both of those in the show notes. So if you've enjoyed our conversation with Michael today and you want to connect with him, go down in the show notes right now, click on one of those 2 links, and you can connect with him there. Again, Michael, an honor to have you on the show. Thanks for coming and sharing your insight with our listeners, and I look forward to connecting with you again down the road.
Thanks so much.